Welcome back, everybody. I'm Jeff Barton, and this is the Mortgage Minute. Hi, how are you? How was your weekend? Things here at the Mortgage Minute have been busy. There's a lot of talk about inflation in the economy. There's a lot of talk about some of the changes being made at the Fed and the adverse market condition fee disappearing, I guess, end of August, maybe beginning of August. That's the fee that they charged you, another half a point as fees on top of your interest rate or on top of the fees that you normally would be paying if in fact you're refinancing. They've taken that away, thus causing the cost of refinancing to go down, which is a good thing for most consumers. As we've seen, both inflation and COVID have taken a bite out of some of the economic news today, and what we've seen is a retrenchment in prices for getting a loan, getting a mortgage. So rates are good. And here they are. 30-year fixed rate is at 2.89, a 15 years at 2.35, 2.50 for the FHA, 3.05 for the jumbo, and the 5/1 ARM is at 2.65. The 10-year is at 1.192. We've talked often about the breaking through of what the yield is and what it means to mortgage interest rates. We had seen it trading between let's say 1.3 to 1.6, 1.7 for about 4 or 5 months. We have now broken through to the downside. Fickle as the market is, the overstimulation of cash infused or put into the market by the Fed, printing by the Treasury, and that's a little confusing for most people. The U.S. government doesn't print the money. The money is actually printed through the Fed by the Treasury. So it's a kind of a symbiotic relationship. Needless to say, it's easier to say that the government's printing money, and that's causing some of the inflation worries, but most of the inflation worries that we see in the market are transitional. Now, what does that mean? It means prices for cars, prices for used cars, prices for other items related to that, gas and hotel fees, airfare. They all are related to supply and demand, as supply is really dwindled during the pandemic, and then all of a sudden the faucet got turned on and everybody wanted to do something, travel, buy a car, get in a hotel room. All those particular costs really had risen very quickly because the supply was not there. Well, that supply will actually ramp up, probably by the end of summer, where we'll see prices calm back down. One of the areas where we haven't seen prices translate to lower prices for the consumer is in construction. Lumber costs last year at this time, $1,700 a board, 1,000 board feet is now down below $7, or about $732 at the moment per board foot. Now that would mean that you have $1,000 or about 60% drop in prices, but it really hasn't registered to the consumer yet. There are some reasons for that. I think we still need more in terms of what the supply chain can offer in terms of getting people back to a price where they think is more affordable. Housing is obviously at the center of a lot of the recovery, and we still see a great demand for housing, both at the retail, at the new home level, and at the used home level, i.e. Previously owned homes. Let's see, what else have we? Yeah, the adverse market fee is a big deal. That goes away. It should make your free finances cheaper. I think the money and the inflation, money supply has really got to be curtailed, and we see from both sides of the aisle, we see the need and want to do infrastructure and spend a lot of money, but at the same time, they don't want to print money. So how's it going to pay for it if you can't raise taxes? Can't happen. So you have to pick your poison in what you want here in terms of how you look at the economy, whether you want this infrastructure bill to go forward, whether you want cheaper home prices, whether you want long-term stability in lower interest rates. All of that has to do with very strong government intervention. I don't have a say in it, but I do know that that is a fact. And for those of us who look at these things and how it affects consumers, currently it's affecting them in a negative sense inflation-wise, but in a positive sense in terms of what the rate is. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the Mortgage Minute, even though it's about 5 minutes long. Anyway, thanks. Bye.